Thousands of years ago, long before digital wallets or even paper money, people faced a fundamental problem. Imagine living in a bustling ancient marketplace. You've worked hard, you've traded goods, and now you have a pouch full of gold or silver coins. This is your wealth, your life savings. But carrying it around is a constant risk. Thieves are everywhere, and losing your wealth could mean ruin for your family. How could you keep your money safe? This simple yet profound challenge was the seed from which one of the world's most powerful institutions would grow. The need for security and trust laid the groundwork for the birth of banking. Our story begins not with a bank, but with a temple. Around 2000 BC, in the fertile lands of Mesopotamia and the grand civilization of ancient Egypt, temples were more than just places of worship. They were fortified, highly respected, and seen as sacred ground. People naturally began to entrust their most valuable possessions, like gold, silver, and even grain, to the priests for safekeeping. In exchange for a small fee, the temple would store these assets in its secure vaults. This arrangement provided peace of mind to merchants and wealthy citizens alike. These ancient temples, acting as guardians of wealth, became the world's first banking systems. It wasn't about an individual offering a service. It was about a trusted institution providing security for the entire community. This was the first crucial step, establishing a centralized, secure place to store value. So, who actually created the first banks, as we might recognize them? The concept didn't spring from a single inventor's mind. Instead, it evolved organically from the needs of commerce. The real pioneers were groups of merchants. As trade routes expanded across continents, merchants needed more than just a safe place to store their gold. They needed a system that could facilitate complex transactions, provide capital for long journeys, and manage the flow of money. Merchant groups in ancient civilizations like Greece and Rome developed sophisticated systems. They kept detailed records or ledgers tracking deposits and withdrawals. They essentially created a network of trust, allowing a merchant to deposit money in one city and withdraw it in another, all without physically carrying the coins. This innovation was revolutionary, transforming local trade into a global enterprise. The idea of simply storing wealth soon evolved into something much more dynamic: lending. The temples and early merchant bankers realized that the vast amounts of gold and grain sitting idle in their vaults could be put to work. This was the birth of money lending. They began to lend a portion of the stored wealth to individuals who needed capital, such as a farmer needing to buy seeds for the planting season or a merchant funding a new trading voyage. Of course, this service wasn't free. The borrower would have to pay back the original loan plus an additional amount, which we now call interest. This concept was a game changer. It allowed capital to flow to where it was needed most, funding agricultural growth, new business ventures, and ambitious trade expeditions. Lending turned static wealth into a powerful engine for economic development. For centuries, these banking practices remained relatively informal. But during the Renaissance, everything changed. In the bustling city-states of 1300s Italy, particularly in Florence, banking underwent a major professionalization. Powerful families, most famously the Medici family, established banks that operated with a new level of sophistication. They weren't just moneylenders. They were financial architects. The Medici Bank created a vast network of branches across Europe, introduced double-entry bookkeeping for more accurate accounting, and developed bills of exchange, which were essentially early forms of checks. These Italian banking families formalized the rules and practices that became the foundation of modern banking, creating a system that was more reliable, scalable, and integral to the flourishing European economy. So why did this Italian model of banking spread so rapidly across the globe? The answer lies in the age of discovery and the explosive growth of international trade. As European ships began sailing to the Americas, Africa, and Asia, voyages became longer, more expensive, and far riskier. A merchant might need an enormous amount of capital to fund a single expedition, and they wouldn't see a return on their investment for months or even years. This is where banks became indispensable. They provided the necessary credit or loans to finance these ambitious journeys. A bank could pool the resources of many depositors to fund a voyage that no single individual could afford. By providing credit, banks underwrote the expansion of global trade, making long-distance commerce possible and connecting the economies of distant continents in an unprecedented way. As banking became more central to national economies, governments began to take a keen interest. They realized that a stable financial system was crucial for national power and economic prosperity. This led to the creation of a new type of institution, the central bank. The first was the Sveriges Riksbank in Sweden in 1668, followed by the Bank of England in 1694. Unlike commercial banks that serve individuals and businesses, central banks were created to serve the government and the entire banking system. Their role was to manage the nation's currency, control the money supply to prevent runaway inflation, and act as a lender of last resort to prevent financial panics. By providing stability and oversight, central banks became the backbone of modern financial systems, ensuring the public's trust in the currency and the economy. Fast forward to today. In a world of digital payments, cryptocurrencies, and fintech startups, you might wonder if traditional banks are still relevant. The answer is a resounding yes. The world still depends on them for the very same reasons they were created: trust, security, and connectivity. When you tap your card to buy coffee, a bank is working behind the scenes to move money from your account to the coffee shops. When you save for a house or retirement, you trust a bank to keep your savings secure. On a global scale, banks are the arteries of the world economy, moving trillions of dollars across borders every day, facilitating international trade and connecting businesses and individuals from every corner of the planet. They are the trusted intermediaries that make our complex, interconnected financial world function. From a simple need for safety in an ancient marketplace to the complex engine of the global economy, the story of banking is a story of human ingenuity and the enduring power of trust. Banks were created to solve the problem of keeping wealth safe. They thrived because they learned to put that wealth to work through lending. And they survived for millennia because, at its core, the world needs a trusted system to manage and move its resources. The technologies may change from clay tablets to blockchain ledgers, but the fundamental human need for a secure and reliable financial system remains. And for the foreseeable future, banks will continue to be at the heart of it.